All right. So you've been riding that bull market wave, right?
Yeah.
And you've got some, some pretty sweet gains. Nice work. But now you're probably also thinking, okay, how do I hang on to all this if things start hitting south?
Right.
And that's where we come in.
Exactly.
We've been checking out this podcast called Using Options to Make Money as the Market Goes Down.
Okay.
And those hosts, I got to tell you, they've got some seriously smart strategies using options.
Yeah, they do.
Which, might sound a little intimidating at first.
Sure.
But that's what we're here for. That's what this deep dive is all about,
Yeah.
breaking it all down. So today we're going to walk through 5 of their top option strategies.
All right.
Each one designed to basically help you safeguard your portfolio if things, if the market takes a dip. You ready to jump in?
Absolutely. Let's do it. And I think it's important to note right off the bat that, options, they can be very powerful tools.
Yeah.
Especially for hedging. They give you a lot of flexibility. They can give you leverage. But it's really important to understand the risks involved too.
For sure. For sure. Okay, so first up, we've got the protective put.
Okay.
This is like having an insurance policy, right? You hope you never have to use it,
Right.
but you are definitely glad you have it if things go wrong.
Exactly. So a protective put basically gives you the right, but not the obligation, to sell your shares
Okay.
at a certain price, a price that you set ahead of time,
Uh-huh.
even if the market price totally tanks.
Right.
So you're basically setting a floor for your potential losses.
Gotcha. Okay. So let's say I'm holding some Apple stock, right?
Okay.
Been doing really well.
Mm-hmm.
I could buy a put option.
Yep.
With a strike price maybe just a little bit below what Apple's trading at right now.
Exactly.
So then if Apple takes a dive, boom, I'm protected.
You're covered.
But if it keeps going up, 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 well, then the option just expires.
Right.
And all I'm out is that premium I paid for it.
That's the idea.
Okay. So then how do you choose what strike price to go for?
Well, it really depends on your comfort level, your risk tolerance.
Mm-hmm.
The higher the strike price, the less protection you have.
Right.
But it also costs you less.
Makes sense.
Lower strike price, more protection, but more expensive. So it's really about finding that sweet spot.
That trade-off.
Yeah, exactly.
So if I'm super risk averse, I might be willing to shell out a little more for that lower strike price just for that extra peace of mind.
Exactly. Yeah. It's all about finding that right balance for you.
Right. Okay. All right. So what about put spreads?
Okay.
Specifically, the bear put spread.
So bear put spreads, they're a little bit different. They're more about making a calculated bet that the market's going down,
Okay.
but within a certain range.
Okay.
So what you do is you buy one put option,
Uh-huh.
but at the same time, you sell another put option
Okay.
at a lower strike price.
Oh.
So it's kind of like you're setting boundaries on how much you're willing to lose and how much you're hoping to gain.
So I'm drawing a line in the sand. I'm like, okay, I'm willing to lose this much, but I'm hoping to make this much.
Exactly. So let's say you buy a put on the S&P 500, right?
Okay.
At a strike price that's, say, 10% below the current market price.
Mm-hmm.
But then you sell another put with a strike price that's 20% below.
Okay.
So now, if the market drops somewhere between those two percentages,
Boom.
you profit.
Awesome.
But outside of that range, your gains or losses, they're capped.
Okay.
So it's a way to manage your risk.
Gotcha. So it sounds like this could be a cheaper option, right, than that protective put.
It can be, yeah, because you're selling that one option to help offset the cost of the other.
All right. Okay. I like that.
But, there's a trade-off. The trade-off is that you have a limited profit potential.
Ah, okay. Higher risk, higher reward kind of thing.
Well, not necessarily higher risk, just the potential reward is limited.
Yeah.
But the risk is also limited.
Right. Okay. All right. Well, let's move on to strategy number 3.
Okay.
We're talking long straddle or strangle.
Right.
These sound like they're for someone who's expecting a really big swing,
Yeah,
but they're not sure which way it's going to go.
you got it. So with a long straddle, what you're doing is you're buying both a call option and a put option
Okay.
at the same strike price.
Okay.
A strangle, you're doing the same thing, buying a call and a put, but you're using different strike prices.
Gotcha.
But either way, you're basically betting on a big move.
Okay.
Doesn't matter which direction.
So if the market explodes upward, I'm good. If it crashes downward, I'm good. What's the downside here?
Well, the key with these strategies is volatility.
Okay.
They really only work well when the market makes a big move.
Right.
If the market stays pretty flat, you could end up losing money on both options.
Okay. So it's a higher risk, higher reward type of play.
Yeah.